Hey everybody, Tom Berry here with ILS Legacy Holdings, and I've got a quick market update for you on the real estate market. Let's talk about what we're seeing out there in the marketplace. Housing, first of all, we still have an extremely low supply of housing, and today I just read a report on a business news channel that housing prices just notched the all-time high in America. So what does that mean for us in the growth fund and the income fund? Well, really in both funds, that's good news. The news is that these assets are continuing to climb in value. And as collateral for us and our loans, we want that to happen. So now on the downside of that, it makes it hard for people to afford housing. So there is an offset to that. But in our business, we are not dealing with homeowners, we're dealing with investors. And currently, as I talk to investors in the single-family realm, what I'm hearing is that under $400,000 in that price range, as fast as they get the houses done, they're still selling them, if the houses are rehabbed correctly. Now, the days of just slapping it together with a coat of paint and some carpet and throwing it on the MLS and getting multiple offers the first day, those days are over. They're not seeing that anymore. But the experienced guys and gals that are going in and doing a top-notch, high-quality rehab, and rehabbed to the condition it needs to be for that particular neighborhood, they're selling them very quickly. So not really a lot of change there. It is weeding out some of the wannabe investors that didn't have the experience and were just throwing things together. Those people are having a challenge. They're not getting the offers on their homes. The buyers of these properties are being picky. They're being very picky. So that's what we're seeing on the housing side. On the commercial asset side, we've seen prices for commercial real estate fall in pretty much all categories over the last year or so, but they haven't fallen a lot. So will they continue to fall? I think it's going to depend on the asset class. I think certain asset classes have come down as far as they're going to for a while. Now, there could be other events that happen that would change my mind, but based on what we know right now of supply, demand, GDP growth, and interest rates, I think a lot of commercial asset prices have fallen as far as they're going to. There are a few that I think may continue to fall, and one I think will continue to fall. The one I think that will continue to fall is office space. Office space has been in a free fall for quite some time, and I don't see it hitting the bottom yet. I think it's going to continue to fall. Now, we've seen a lot of slowdown in the fall because a lot of this office space is being repurposed. They're being repurposed in a multitude of ways. As that happens, that takes more space off the table, less available space, props things up. So we'll see how that plays out, and I think that's going to be different in every single market. What happens in Dallas, Fort Worth may not be the same as what happens in Chicago, for example. Other places that I think we're going to still see a little softening is we're still going to see a little bit of softening in retail. Now, retail is my favorite right now, and it's my favorite because there's a lot of softening. And the entire sector of retail is being hit because of a certain segment of retail. And that's good for us because we don't play in that segment, but the whole asset class is being hit by it. Now, what do I mean by that? Right now, a lot of people think that the internet and internet sales are putting all retail out of business. That's not the case. It's not at all. The facts are, right now, nationwide, there is only a 5% vacancy in retail space. 5%. That's very low. But the perception is that retail is hurting. Now, it is true that retail was hurting 10 years ago, But now a lot of that has worked its way out of the system. And how did it do that? It worked its way out of the system the same way office space is working its way out of the system as we speak. A lot of retail space was repurposed into other things. It was taken off the board. It was taken up. We have a property under contract right now, a shopping center, where a lot of the space is actually office space. It has 2 government agencies in it, and it has a medical center in it. But it's in a big strip center. It's in a big shopping center. And that has been happening over the last decade. So why would somebody move from office space into a retail center? Visibility. Free advertising. If you have a doctor's office, let's say, and you have it in an office building, nobody's going to see that doctor's office. You have to advertise and spend ad dollars to get people to come in. But if you're in a retail center, as they're driving by to go to the Dollar General store or whatever else might be in that retail center, they see your doctor's office. If they're looking for a new doctor, you might get a walk-in. So we've seen a lot of that happen over the last decade from office to retail, and now we're seeing a change in retail because there's not as much space available. A lot of that extra, what we call dead space of the past decade, has been taken up. So that's what we're seeing on the commercial side. Another one I think is going to be a little soft is going to be apartments. That has been highly saturated, and I think apartment prices have been in a bubble for some time. We've seen a little bit of softening there. I don't know if we'll see more, but I suspect we will. I think that needs to come down at least another point in cap rate for it to equalize. So what are we seeing in-house in ILS? Well, the first thing that we look for is late payers. And are people paying their payments late to us? And as of last month, we're not really seeing any difference in late payers than what we typically see. The next layer that we look at is defaults. How many people that paid late didn't get caught up and actually got a default notice? That we have seen a little uptick in, but we'll see an uptick, and then the next month it's back to normal, and then an uptick. So really there's no cause, we don't have any alarm or cause for alarm there. The next one, and this is the one I really focus on, is REOs. How many properties have we had to take back from borrowers, and then we have to dispose of them? And that's where they didn't get caught up. They went to default, and they still didn't get caught up, and we had to go through, most generally, the legal process in that particular state to take that property back. Most generally, when we look back over the last 4 years to 5 years, we have had anywhere from 7 to 10 REOs on the books at any one time. When I looked last week, our REO list has 7. So we're at the low end of our historical 4-year average. Now, what is ironic, though, is we have twice as many dollars on the street, twice as much loan volume as what we had 4 years ago, and we're still running about the same in REOs. So that is real good news to us. Of course, we'll keep an eye on it, and we'll watch for any movement up in any of those categories. But that's basically what we're seeing in-house. Right now, we have more deal flow than we have capital, so we're looking for more capital. And of course, we're constantly pouring through the deals that do come in, loan applications that do come in, and we'll cherry pick those best ones for the funds. Here at ILS Legacy Holdings, we are dedicated and committed to helping you plan your path to wealth as an active or passive real estate investor. Visit ilslegacy.com to see how our companies bring investors together to help meet their financial goals.